Hey everyone, welcome back to Corporate Decoder, the place where we dive into the nitty-gritty of corporate filings so you don't have to. Today, we're cracking open Oxford Square Capital Corp's latest 10K. It's a BDC, a business development company, and let me tell you, this one has a few twists and turns that might just leave you scratching your head. We're talking complex investments and a fee structure that, shall we say, could be a bit more aligned with investors. So buckle up as we decode what's really going on behind the financial jargon. Oxford Square Capital is like a specialized lender. They give money to other companies, but they're not your everyday bank. As a business development company, their goal is to help smaller and sometimes troubled companies grow, make acquisitions, or just keep their operations running. They mainly invest in corporate debt, basically lending money to companies. However, the report notes their debt securities may in turn be referred to as junk. These can be very risky. They also invest in something called collateralized loan obligations, or CLOs, which are like pools of loans bundled together. Now, CLOs get a little complicated. Think of them as entities that buy up a bunch of commercial loans. To buy those loans, the CLOs borrow a lot of money, essentially leveraging their investments. It can magnify gains, but also the risk of losses. Oxford Square Capital isn't just buying the safest parts of these CLOs. They're often going for the equity or junior debt pieces, which are riskier because those pieces are the first to take a hit if things go south with the underlying loans. This is like betting on the riskiest part of an already risky structure. To get more money for investing, the company raised capital. They did this through an ATM offering and a rights offering. An ATM or at-the-market offering is where a company gradually sells shares over time through a broker. For Oxford Square, it meant potentially selling up to $150 million of their stock. And a rights offering gives existing shareholders the opportunity to buy new shares at a set price, which can prevent dilution of the investment. This means the opportunity to buy more stocks at below-market prices, which increases the ownership stake of the shareholders. Let's talk about who's running the show. Oxford Square Management is the company managing Oxford Square Capital's investments, and that management is owned by Oxford Funds. It's worth noting that Charles Royce, a member of Oxford Square Capital's board, owns a minority interest in Oxford Square Management. This setup creates a specific fee arrangement that can, to some observers, seem to incentivize the management to take on more risk. Here is where it gets tricky. Oxford Square Management gets paid a base fee based on gross assets, meaning even if investments aren't doing great, they still get a cut. On top of that, they get incentive fees based on Oxford Square Capital's performance. This combination of fees could encourage the management team to increase leverage, borrow more money, and invest in more speculative investments to try and boost those short-term returns. It could even cause the investment team to encourage its portfolio companies to make payments in a way that helps the investment manager get paid. All of that, of course, could work against shareholders' long-term interests. Now, Oxford Square Management has put in what they call the 2016 fee waiver as an attempt to better align management's interest with the stockholders. Let's try to understand this. This 2016 fee waiver modifies some of the investment management agreement terms. Essentially, if this fee waiver generates lower fees for the investment manager, those lower amounts are paid out. If not, they retain the previous amount. Oxford Square believes their expertise in analyzing these complex investments and close ties to the financial community give them an edge. They tout the extensive experience of their leadership team, specifically highlighting the backgrounds of key figures like Jonathan Cohen, the CEO, and Saul Rosenthal, the president. The team makes sure that they are investing in quality companies and CLOs. Oxford Square identifies companies with experienced management, strong market positions, and financial backing. Ideally, these companies are already generating cash flow. They also look at the liquidation value of assets, which is like figuring out how much the company's stuff is worth if they had to sell it off. For CLOs, they focus on the quality of the loans the CLO holds, the structure of the CLO itself, and the expertise of the CLO's manager. The company employs a credit grading system to keep tabs on the quality of their debt investments. They use a scale from 1 to 5, with 1 being everything's great and 5 being we might not get our money back. The corporate loan market did okay in 2024. It is noted that lower quality loans did better than higher quality loans. However, loan defaults also increased, so it was a bit of a mixed bag. The report has a huge section on risks. A major risk that they mention is that Oxford Square Capital depends heavily on Jonathan H. Cohen and Saul B. Rosenthal, and that, should they leave, the company would be in trouble. It's a reminder that even the best laid plans can be derailed by unforeseen circumstances. It also notes that the market for investment opportunities are very competitive. The debt capital that will be available, if at all, may be at a higher cost and on less favorable terms and conditions in the future. Another big one that is not unique to Oxford Square Capital, is that the board can change the investment objective, operating policies and strategies without prior notice or stockholder approval. As a RIC, Oxford Square doesn't pay corporate income taxes as long as they distribute at least 90% of their income to shareholders. But if they mess that up, they're looking at a hefty tax bill. And as a BDC, they have to maintain a certain ratio of assets to debt, which impacts their ability to make distributions. There's also a risk that investors in the equity securities will not receive distributions, or that the distributions will not grow over time, and a portion of our distributions could be a return of capital. Let's not forget about cybersecurity. The report states that Oxford Square is facing an increasing challenge. They are at risk for cyber attacks, which could result in financial losses or a disruption of its business, liability to investors, regulatory intervention, or reputational damage. Finally, they address hedging. A rise in interest rates may increase the cost of debt for our underlying portfolio companies, which could adversely impact their financial performance and ability to meet ongoing obligations to us. Now, let's take a look at some numbers. On the positive side, cash and cash equivalents increased significantly, jumping from roughly $5.7 million to nearly $35 million. That's a good sign. But investment income is down, primarily due to multiple restructurings and refinancings that occurred in the year ended December 31, 2024, and a decrease in floating interest rates. Their asset coverage is at 227%, which means they have $2.27 in assets for every dollar they owe. So that's positive news. The board has in place a few measures, including the Code of Business Conduct, to ensure there isn't any misdoing within their own organization. In a nutshell, for the year that we're analyzing, ended December 31, 2024, the company lost less money compared to the previous year. Now, zooming out, what's our take on Oxford Square Capital? Oxford Square Capital appears to be navigating a complex landscape, but are they doing it well? Their strategy of investing in riskier debt and clo positions, while potentially high reward, requires skillful management to avoid major losses. The increase in portfolio liquidity and capital resources appears to be strong and positions the company for more opportunities. However, the high fees, particularly the incentive fees, do raise questions about alignment with investor interests. The decrease in interest income is concerning, however it does not present any current alarm. If I were to consider investing in Oxford Square Capital, I would ask myself, is the risk that comes with their more complex investments worth the potential reward? I'd also take a close look to see if the incentive fees are excessively lining management's pockets at the expense of shareholders' long-term gains. There are potential profits to be made, just make sure your investment thesis matches the risk profile of the company. Thanks for watching Corporate Decoder. Remember to do your own research. If you found this helpful, please subscribe, like, and comment to support the channel. Until next time.